Hey everybody, welcome to this week's video, mid-June already, just a couple weeks left for those with the kids before school is out. Amazing to think how close we are to summer as the days get warmer here. Tensions in the geopolitical world are definitely increasing. Iran and Israel war at the moment. We've seen a few of these geopolitical events over the last few years, which just add to the volatility that we're already going through. So let's talk a bit about what that means for the portfolios as we go through. So just to step back and take a look, of course, we've had a ton of geopolitical events over the last 125 years, and here's just a few of the major ones. You can see that some of these do affect the markets in the short term, others not so much, but in the long term, which is what we're planning for if you are a investor, uh, we can see up and to the right through all of these eventually coming back to all-time highs. In this case, will be no different, although there will be volatility. That leads me to the next slide here. So seems like it's been a very volatile period here. President Trump coming in, the tariffs, all these trade talks, and now some geopolitical events on top of that. But just a reminder that 7.2 times per year on average, you're getting a 3% dip, 3.4 times per year, a 5% mild correction. Once a year, you're getting a 10 over once a year, a 10% correction on average. And worse than that, every second year, you're going to see a 15% or worse correction. And every 3.5 years, and that's kind of where we state it, every 3 or 4 years, you're going to get a 20%, we call it bear market, a 20% correction on the markets. And that's just the history going back almost 100 years that's the case. So there is a lot of volatility out there every year. Some worse than others. A lot of these smaller dips we forget about. Some of the larger dips we even forget about as they bounce back quickly. But just a reminder that that is regular for the markets to give us this volatility and these negative periods. But then we continue to march higher, and that's, as it says, the toll we pay to invest and earn those higher returns. A bit of a funny one here. This is the Rocky Balboa reference. So this is looking at what happens the day after a negative day in the markets, going back year by year, back to 1980. And you can see that the average in between the 0.1 and negative 0.1 percentage movement the day after a negative market. We've had a few. You're looking at 2003, 2008, 9. The latest one in 2020, a 0.39% upward movement after a negative day. We can see that that volatility is here. We've had a number of negative days, of course, but the average return the day after that is almost 0.3%. So, Rocky Balboa style bouncing up off the mat after a negative day. We'll see if that trend continues, but that's much higher than you'd normally see on a rebound from a negative day. And what does it mean long term now? So we of course had some slightly positive markets coming out to start the year in January. Those markets flipped negative all the way through March and into April. And then we had a very strong May, one of the strongest on record. And now we've gone almost 2 months here of a positive gain, up over 20% in those 2 months. So what does that mean going forward? You can see all green numbers across there going back to 1950. There's been 5 different occasions where we've had a 2-month period of strength like this. And you can see the 1, 3, 6, and 12-month returns all positive. Going out 12 months, of course, very tough to determine the shorter the time period. So I like to go on the further out 12 months, a 30.8% average return. And like I said, 100% of those times. Now, of course, that's only 5. As mentioned, we have some seasonality here. Usually starting in May, the markets are slightly weaker, not necessarily negative, but not as strong as they are at the beginning and the end of the year. Of course, May was very strong, gets much quieter as we move into the summer. We'll see if that means positive or negative, or we just kind of trend sideways here. But this historic number showing that we have potentially some very positive movement up ahead based on the positivity we've seen in the last 2 months. So keep that in mind. Of course, the way through this, all volatility, a well-diversified portfolio, find some assets that aren't correlated as much to the US, the Canadian market, looking at small caps, looking at other geographies, other sectors, alternatives, that sort of thing that can really reduce the volatility of a portfolio without hurting that return. And that's the way we structure our portfolios. So any questions in the meantime, let me know, but I'll be back with another video in a couple weeks. Take care and enjoy the end of June and the beginning of summer.